104%. That's the tariff that is set to hit China on Wednesday if a deal cannot be done. And credit markets are absolutely imploding. With the US 500 retesting back near the lows and the rest of the markets around the world crashing around us, what are we looking at? Well, the volatility of the VIX itself is spiking to near all-time highs. And this means bad things when it comes to capitulation selling. Could we be looking at another new low? Are we at peak fear? In today's video, we take a look at the good, the bad, and the downright ugly when it comes to the options market, dark pool liquidity, and of course, stocks, commodities, and cryptos around the world. Guys, this isn't getting any easier. Let's take a look right now together. Well, welcome back everybody to The Daily Show. My name's Tom and we have a lot to discuss about. Markets sold back near the lows. Bonds markets, more importantly, started to freak out. And in today's video, we'll show you several indicators around that. And of course, we've got the latest macro data and everything else. If it's your first time here to the show, make sure to subscribe and hit that alert button. We'll be covering everything you need to know about the markets over the next days, weeks, and indeed years. So as we've been following recently, we've been talking about bond spreads expanding out. And as you guys know, it is not good when the bonds market is freaking out. And it's started to accelerate. As you'll see later on today's video, bond spreads and in fact bonds in corporate debt is now started to become the problem. And the issue is, it's not just about tariffs anymore, it's about the stability of the entire financial system. The longer tariffs get discussed, the longer tariffs sit in place, the worse the debt problem could become. And as we have zombie businesses across many areas of the Western world, how many of those potentially could be failing over the next 12, 24, or even 36 months? This is the discussion that is now going on throughout Wall Street, and obviously we need to watch it. What will we be looking for? Well, of course, a bottoming of bonds, and this is going to be basically a sign that the credit markets have said, you know what, okay, we're not seeing fear anymore. Speaking of fear, this is a big signal of peak fear. The number of technology stocks now above the 50 EMA as of Monday was exactly 0. Now, that is pretty rare. And in fact, if you notice back over in the previous times we've seen anything like this, as you can see here from Seth Golden, that is incredibly unlikely to occur. And when that has happened, traditionally, it's been a maximum fear signal. Now, notice this back in 2022. While we did find a new low afterwards, it was still around the basing structure. During 2020, it was, of course, the base itself. And during, interestingly, the flash crash of 2018 into 19, which was, of course, the trade war with China, funnily enough, we actually did see a lower low being formed before rallying back. So can it be near the lows? Traditionally it is, and it is an oversold signal nonetheless. Now we've seen many of these peak fears starting to come through, but have a look at this one from Bank of America. According to Bank of America, as one of their analysts, they believe that now the S&P target is 5,600 by the end of the year. And that's a pretty big decline from where they have been, which obviously is well over 6,500, etc. We revised our target framework to incorporate a lower S&P 500 level, they said, for return models and higher discount rate. But we see a wide range of outcomes from here. Obviously, as you can see here, their time horizon, their current weights, everything has changed. But what this basically is telling you is Wall Street economists are panicking. And I take us over here to the latest post here from Ray Dalio, which you may be interested in having a look at. And you can check it out over on X and have a look at the comments here. Now, one of the things I kind of wanted to go through was not so much that, but I thought I'd just quickly go down here to the discussion, or at least what the discussion points were in terms of an AI overlay. And basically what Ray Dalio was getting at is that we are, seeing tariffs as a symptom, but it's not the core issue. Now, I agree with this. Obviously, my big thing here has always been debt. I talk about that in our advanced masterclass. Links in the description down below if you're interested in following that. And obviously, I believe this is a politically based debt problem across all spectrums that's been permeating for a very, very long time. Now, the issue here is we've got a geopolitical shift, which I agree. And of course, we've got all sorts of other things that are going on along with the technology revolution. Now, when you think about it, what tariffs are doing is exacerbating the already existing problems. And this is leading into, flash sells across all the board. And of course, credit markets are now starting to smell a potential crisis period. Now, if we go into a crisis period, things could get much worse before they get better. If you take a look at this chart here, you will notice that we could go into what they call a Lehman Brothers style meltdown, and that is a super flash crash. Now, you might think this is bad. Yeah, it can actually get worse. I'm not saying we're there yet, but credit spreads, volatility indices, all of these types of things, at the moment, they are currently all red, which tends to be usually in bear cycles. So what that means is that we have entered into a point with this volatility that went past that 12%, past that 5,400 level just the other day, that suddenly triggers all sorts of previous reoccurrences with bear markets. That is markets that rally a ton, dump a ton, stay volatile for a long time, and potentially won't reach new highs for a very long period. We have to, of course, navigate these times. Here is another bad stat. We went down over 15% in 2025. What happens by the end of the year? Well, according to Ryan Detrick here, since 1950, that is 70 plus years of data, what have we seen happen by the end of the year? Most of the time, other than recently, which of course has generally been the Federal Reserve kind of saving the markets, but we've traditionally seen markets go worse. That is, that they will actually be red by the end of the year and not so good. This is already building in poor structure for 2025, and it means that we have to be on the outlook. And the reason why is quite simple. No recession in bear markets, that is a market that goes from the top to negative 20%, is pretty rare. Now, we did see 2022 be a unicorn. 1987 flash crash was a unicorn. And we have to admit that if a deal is done, if tariffs are removed or reduced heavily, then we could still be in a unicorn period. A lot of you may disagree with me in the chat and comments. That's the beautiful thing about markets. Of course, we all have opinions. But what I find very interesting is this one over here, as I mentioned in the previous video. We had a no recession unicorn followed by a recession. We had a no recession unicorn. Will it be followed by a recession? Ultimately, it depends here what deals can be done, because the market is starting to, really go from tariffs to debt to systematic problems to all sorts of other things. And as you'll see, the bond indicators have not relented. Even though the market might be just at lows, bonds have actually dropped below those lows. And that is a big issue. Now, when it comes to NASDAQ Composite doing what it did last week, Thursday, Friday, massive 5% declines. 1 day, 2 days later, usually you'll be a bit green. And then, of course, you can go back into the doldrums. As you can see here, many cases, the next couple of weeks can be incredibly volatile. What this tends to do is it tends to put in what they call a low structure, which is a point where you usually sit around and you find a lot of volatility. It doesn't lay out, though, that we will not see a new lower low. And the reason is because of this. S&P 500 after the VIX closes above 45 for 3 days straight. This is now, I believe, day 5 that we've seen VIX above whatever that read is. We'll look at later on, 27.3 or something. And that means that we are now getting into the dangerous territory of traditionally being potentially red by the end of the year. Have a look here when VIX goes this high for that long. 1 day later, not good. 2 days later, ooh. 3 days later, yeah, that's not good either. So while this can be fixed, and of course it can be fixed very quickly, the problem is the stats have gone from being, okay, more bullish, and we did see a little bit of relief there. Obviously, we know the speed of which we got that fake news coming out, and literally the speed at which the markets can recover, negative 5.5% on semiconductors to 5% on semiconductors in the matter of minutes. If that doesn't happen, we've got some issues here. S&P 500 after it's down 17.5% year to date at 1 point in April. Again, bit of a cherry-picked stat, but as you can see here from Subaru Trade, still some more volatility potentially to become. And again, similarities with what we call the Great Depression. Let's hope we're not going into something like this. As we mentioned in our previous video, bullish percent index hit critical lows. Very rare to get down to these numbers. We traditionally see this with bouncing levels, fear levels, structure levels. That happened on both the S&P and that also happened on the NASDAQ. So this means that, again, markets have kind of hit those critical zones. And as you can see here with this great chart from Duality Research, you'll notice that we've hit 10-year averages. So what that basically means that if you were looking at the market itself, if you think about energy, it's actually only trading at 12.8 times, which is under the 5-year and 10-year average. So energy, obviously cheap, but that doesn't mean you should be in that area. Communication services hit 10-year averages. Healthcare's hit 10-year averages. Technologies hit 10-year averages. We've basically mean reverted across the board. So we've gone from an overbought, overvalued market to kind of like what it's been trading at for a long time. So in some ways, you would call this almost mean reversion. The issue is now, what are the repercussions of this particular stuff. As we mentioned, the longer tariffs sit in, the longer or the more damage that will probably be done if they're this big. Why? Because companies will stop hiring, they will cut the top off, which basically means the top 10%, 20% of cream that they don't need in terms of staffing. All of a sudden, they'll fire those people. And I have it on fairly good evidence so far that we're starting to see buybacks cripple. So what that means is that companies are saying, oh, I'll just keep on, I'll keep the cash for now. And what they're doing is we're only looking at 1/3 to possibly 1/4 of the buybacks that we were at the start of this year. Now, the issue with that is, as you know, buybacks have made a huge impact into market demand. And 1/4 of $1 trillion, that's a lot of money that suddenly just got sucked out of the market. So are we heading for a recession? I'd be interested to know your comments down below. Let us know. I'm going to read them over the next 24 hours and check out what your opinions are. Now, of course, many people are countering this with the Smoot-Hawley tariffs of the 1930s, where we had a ripping market. We ended up seeing a decline of like 40% in a flash crash. Markets rallied, and then, of course, things got worse. Now, will Liberation Day go down as a game changer like that? Again, it depends how long things hold in. RSI, other indicators, look, it's pretty clear that everything's overselling. These are flash sells. These are usually symptomatic with lows. However, market structure has only improved on small timeframes. And as you'll see later on, big indicators that many of you may not be aware of, but I've been using for a long time, such as copper and gold, they absolutely tanked this week. And what that traditionally tells us is growth in the world is tanking. And that basically means yields have to come down. Now, you may look at the US 10-year and say, oh, the US 10-year's up though, Tom. Yeah, as you can see here, it does tend to lead. It's a lead indicator, and it is showing right now fear on the street. So basically, while yields look like they're going up, realistically, the impact of the tariffs, the impact of this world global trade kind of war that we're in at the moment, this is going to have long-lasting, dramatic, implications according to copper gold as a ratio. Now, we said that 27.3 is the key. If we go 11 of these days above 27.3, which it looks like we may, again, some of the worst S&P 500 end-of-year returns have come with that. Again, bad structure, bad ideas. We saw just a week ago, before even some of this happened, the S&P 500 break its quarterly streak. That was at the end of March. That tipped off that we may still get a stabilization quarter traditionally, but unfortunately the stats do not line up for the next couple of quarters. So again, this is a kind of fixable situation to a degree, but we haven't seen any of those signs yet. Remember, it's news driven. It's very difficult right now to go in there and say TA on anything more than small timeframes. That's why on Monday we talked about the 15-minute double bottom. So far, that's actually still holding even at the time of this recording. But because it's news driven, big shocks such as 104% tariff can certainly push this thing around. S&P 500 volume, as you can see here, big trades came through the other session. We can also see here that we haven't seen a recovery, that the market's really holding in. Near the close, another big trade came in on the SPY. The SPY is the most traded ETF. So these big trades, even though it's 88th biggest trade, 5th biggest trade over here. Now, when it comes to what's going on around the world, there are some good periods or areas that we're at. We're at what we call correlation. Now, even with the 104% tariff discussion, obviously I think, well, I hope this de-escalates a bit. We have come to most traded level on HSI. We have come to a NASDAQ level that obviously is very attractive from a support resistance zone being this structure over here. And of course, we saw silver in our previous video. We saw the S&P 500 and many others all hitting key zones. So if we load up S&P, you'll notice down here, when we have a look at this on the daily, we do have a undercut of this low down here, which is 5,049.50. And we have seen that kind of barely hold on the daily. So see here on the real market, that is the actual S&P 500, it held the 49.50 low. So for now, the 49.50 low, 5,000 level is the hold zone. You'll see that when we look at the S&P. Make sure you make your gaps very well known. You've got a gap here at 56.69. 5,400. Both of those will be resistance if we're able to get up. And you can see here, I've got an anchored VWAP, which is tracking the market. So that's going to be another one that if we do see relief rallies, this is the type of area where bears could be sitting. And my suspicion is bears will sit around 54 to 5,500 looking for resells. We'll go through that more if we do actually see recoveries. For now, though, market structure, of course, has improved down below. Let's take a look at the futures market to get a bit of an idea here. This is the 15-minute double bottom we talked about, the liquidation. Obviously, the movement up, markets were looking, okay. And then, of course, the 104% tariff discussion began and it tanked them back down. So we could see an undercut here followed by a rally. We have now seen several prints that are showing us oversold statistics. Here are the latest, option high lows. They're going to be wrong because, of course, as you guys can see, market action is happening after hours at the moment. But we do have quite a lot of very significant key zone levels that we just usually don't get without it being very close to structural lows. Of course, news driven, crazy things happening. Obviously, you do want to see structure as much as you can. Let's now have a look at the S&P 500 from the put zone. 5,000, 4,800, 5,000, 4,800. It's pretty much the same thing. 47 even opening up now with puts. And as you can see, as of the 10th of April, there are puts everywhere. So we are in super negative gamma still. We are in waterfall possibilities. And if the market is going to find supports, 5,000, which is under, we're currently under that price, but still that's a key level. And then, of course, 4,800 and 47 on the option side. Let's have a look at some of the big stocks. Nvidia tried, guys. Semiconductors did all right for a little while there. Again, $90 the base at the moment, and even 85 and 100, 105 gets us back into actually positive gamma style squeeze scenarios. With Tesla, we're back down at 220. That's traditionally been a bit of a buy, although 200 has now opened up. So it's always been 220, 250, 220, 250, 280, those kind of zones recently. But I think now the market's saying, you know what, I could move easily to 200. So 220, if that gets given up, we could go down to 200. We'll look at that in a moment. So let's talk about the VIX. The VIX spiked up big time. Short VIXs, of course, are a dangerous trade, but often the ones that people like the most. We did see, of course, that come through, as in it went from 60 down to the 50s. The problem is the volatility of the VIX, which we're using more so nowadays because of the 0DTE options, has entered into some of the rarest periods that we ever get. And these rare periods tend to, again, be systematic of bottoming zones. Obviously, they're max fear. There's no doubt about that. You can see the one here where we went even higher was the 16th of March. And if you go back and have a look at your charts in 2020, I think we bottomed somewhere a little bit after that. So again, markets can fall more even after these high fear levels come through. But there's no doubt that we are in historical times with very rare VVIX. And when you get this VVIX, you're looking for it to get crushed back down. And if it gets crushed back down, that's a good sign that you're putting in a temp low. Again, bonds market should recover, and this needs to recover. I noticed this in our last video. We talked about it. This is my bonds indicator. Again, it's in our advanced course if you ever want to get it. But basically, the thing here is that this is not good. Now, is this absolutely shocking? Not yet. A real bonds freak out looks like this. Okay, that's an illiquidity event. That's obviously 2020. If we go back over to the global financial crisis, you can see here a true freak out. Like, we haven't even seen a bonds freak out yet, like a true one. And that's why when you're looking at this, you're like, wow, this is a support. It needs to find a bounce. We're looking for this to bounce along with some of the other things that we've got going on right now. So obviously we want market structure. We want deals to be done ideally, some kind of reduction in tariffs, news to kind of, turn towards the positive side if you're looking at the buys. And of course, if you're a seller, then you just want bedlam. I mean, I'm pretty sure that's what you want. But yeah, you are starting to bet against some pretty significant stats now that we've seen some of these things. Percentage of stocks above the 200, 50, 20, all of these things, absolute rock bottom. Not absolute. Of course, during this March 23rd, we actually hit 4, which has been the epic oversell. Epic oversell. So if that hits a 4, wow, that is highly likely to be near the lows. But it can go worse. But statistically, again, this is where people often do look. And we'll find out whether we get structure here. As we mentioned, copper gold is tanking. Been tanking for a long time. Not as good an indicator as it used to be, but we're certainly not looking at what we would call a recovery right here. This is a weakness in the economy being shown here between copper and gold, and it is not a good sign if you are a growth specialist. That is someone that's looking for a lot of growth. Not the best thing. So obviously being down here at the support, we have hit some cross correlation even on that indicator. US dollar tanked, but really most currencies were tanking. And that is, something we'll keep watching. It's not really moving at any excessive speed, and gold held as well as it could. So if you look at a gold chart and you go down to the smaller time frames, you're probably looking for a break of these highs here to really say gold's trying to get a new high, all-time high, and that's a 3,055 an ounce. Silver held up pretty well around the levels we've discussed. In fact, this became even a better trade theoretically on the smaller time frames, quite replicable. Let's hope it makes a new high again. Nice to see where it is. We'll find out whether there's a buyer above here as well at that 30 kind of 85. That could be a good sign that markets are starting to recover, and oil is getting destroyed. Now, this basically shows, again, similar to copper gold, that we are in growth concerns now, debt concerns now, significant problems starting to appear around risk assets, and that's certainly starting to appear here. 220 got hit on Tesla, traditionally has been the buy so far. We've talked about that a lot, 220, 250, 280, and 300. And of course, now 200, I believe, is open. So be careful here. If markets continue to tank, 200 could be hit on Tesla. Semiconductors still around the most important support. We actually saw structural improvement on the 4-hour and 2-hour. We'll just load that up for you. Hopefully it loads. There we go. So actually we'll go 2-hour. And you can see here, this is actually structural improvement. Technically, a day trader would be looking around here and saying, delish, and then putting stops below the low. But as we know, it's unusual times. So obviously that's a key one. And notice as well that the 2-hour 20 has been rejected twice. So that's also a good sign. If markets recover back past 195, again, could be starting to put in a real, more significant temp low than just the 15 minutes on the Monday session. German 40 tanked, recovered, pulled back a bit. Obviously, news of the tariffs, news of everything going through. NASDAQ obviously has declined back down to significant lows here after all of this news came through. We'll see whether it can find a bid. Again, bid helps structure. The other option is we take a low, rally through. That's actually a very strong low if it does happen, so we'll look for that. And do not discount the lows being swung. It's very possible depending on how the news goes through over the next 24 hours. It's a tough time for stop losses because, of course, they can get hunted very quickly in what could become an illiquid market, which is obviously dangerous in itself. We have a quick look here at NVIDIA as well. You'll still see it's really holding above where it was. So that often tells us that there is a inherent strength in the market, even with this insane tariff discussion, because basically we've got a low down here that's super low. The market recovered, and then yes, it's sold off. But again, is NVIDIA holding up better? Are semis holding up better than you'd think? Yeah, and that's because they hit super critical oversells. And basically, the market really was starting to price in the extreme fear. US 2K not doing well. Quite a few businesses, in this index don't make money. So obviously, if the bonds market's freaking out on corporate debt, then that is a bad sign for the Russell. We'll see whether we can get a bid back above these levels. And of course, we'll come back to this as we see it. Now, in the crypto world, really, we've got to kind of scale in on the idea of Bitcoin really is the chart to watch. Similar, when you get these high VIX, you have to look at Bitcoin. Bitcoin is about to make a new low. If it does that, it could be going 68K and liquidating down to these levels. 68K is probably a pretty damn solid level, but unfortunately just no real bidding. And that's what we kind of talked about. It was like, we need above this or this. It's very difficult. So as we suspected, Bitcoin is not the hedge that gold is at this stage. It is still a risk asset. And for now, anyway, the bears are in control of this because you can see here that this is a real possibility. I mean, the trend is down. I mean, it is what it is. So if we start to regain levels to look at 81.2 and 80 kind of 9 area, those are both going to be key. FOMC coming out on Wednesday for the meeting minutes, so that may be important. We'll see what happens there. Inflation report 8:30 a.m. Thursday. That'll move markets, no doubt, in volatile times. And then PPI. But really, I think the problem here is, guys, it's just all tariff discussion, negotiations. That's all that matters. It's minute by minute, second by second almost, and of course, day by day. And what we're looking for is we're looking for signs of a base and signs of news turning around. And at this point, news seems to be escalating. We don't even know about reciprocal tariffs. If I look, my guess would be that China will just reciprocate with the same amount of tariff. That's traditionally what they've always done in history. It's tit for tat kind of thing. So you've got to remember that, as we showed in a previous video, the thing about the tariffs is that, when China's not buying that much from America, so percentage of GDP is like nothing. And that is why reciprocal tariffs are likely if no deal can be done or something can be kind of worked out. As always, guys, make sure to be careful out there. It's wild time. Subscribe to the channel. Check us out next. And of course, follow us on some of the other socials, including LinkedIn. Thank you so much for watching. We'll be with you again at the close. Obviously, if you want to join our private community, get access to the opens, you can do so through our flash sale. And yeah, I'd love to see you in there. Otherwise, stay safe out there, guys. And just remember that markets will do anything, whatever possible to make you and everybody else seem as stupid as possible. So basically, they will liquidate, they will make lows, they will do these types of volatile times. The key here is to be patient, to look for your opportunities, to look for where you have edge, and then, of course, hopefully make the correct decisions. Bye for now. We'll see you in the next one.